In this video, we're going to be going through the wheel strategy, what it is, how to use it, and how to estimate your potential profit. So quickly, what is the wheel strategy? All it is finding a share or a stock you want to buy, and you sell a cash secured put on it at a strike that you would want to buy it. And then once you finally own those shares, you move that to a covered call and you start selling covered calls at the strike you want to sell the stock you bought. So that's very simple. If you don't already know what both cash secure puts are and covered calls are, check the first videos in the description. I will have both of those. I've already made videos on them to simply explain what they are. But to get into the actual wheel strategy now, we will go on to Norwegian Cruise Lines, ticker NCLH, because this stock is quite volatile and it's quite a cheap stock. And if you know, doing cash secured puts, obviously you have to buy 100 shares. So we don't want to do it on something like Apple, at least an example, because not everyone has, $10 to $15,000 lying around to take that trade. So instead we'll do it on something like this, which will only cost around $1,300 to take the trade. And we will also be using the on-demand feature, and the reason for this is we can then get accurate prices as if this was a real trade. So to get straight into it though, we are now looking to buy Norwegian Cruise Lines, and we're saying, okay, if it's at $13 or below, we're quite happy to buy Norwegian Cruise Lines. And so now we've made that, we've said we want to buy Norwegian Cruise Lines, we then need to go over to the option chain. So what we can do now is come over to Norwegian Cruise Lines, and we usually want a 60-day or less expiry, and the reason for that is we are selling options, and when you're selling you want time decay to be in your favor, and time decay hits its heaviest in the last 60 days. So for this example, how about we just go with 30 days, and we can say we need to be looking at the puts, and as we said, we want to buy at $13. All we would do is sell a cash secured put at $13. So we sell that, we would receive $87. So we will go over to the Excel sheet and start putting in this information. So cost per share would be $13. Premium of put, I think it was 87, but we can check that. Yes, $87. And premium if from old puts, as of right now we haven't had to sell more than one put, so that stays as 0. The only time you put information into that field is, let's say we sell this strike at $13, and when expiry we are still above $13, but we want to still take this trade. All we would do is then sell that put again. We would take the 87 over to there, and whatever we receive on the new premium, say it's $20, we would put there. And then that would just give us an easier real cost. But as of right now, we haven't had to sell any previous puts, and we're receiving $87 to sell this put. So we can see our real cost per 100 shares, and this is the collateral that you need to know that we have, is $1,213. So that's how much you need to be able to take this trade. So now we come over, and what we need to do is then go to expiry. So we see this expires on the 8th of July. So 8th of July, we will go to market close, so at 16:00, so 4 p.m. And we can see, did this close where we would have to buy the 100 shares. And we can see it expired, and Norwegian Cruise Lines was at $11.50, so below our $13 strike, which means we would have had to buy these shares. So what we can now see, we don't need to add in any more information here. And as you can quickly see as well, if it's blue, you have to enter information. If it's green, it will give you the answer. But what this now tells us is our break even per share is at $12.13, which is basically a 6.7% discount from where the stock roughly was when we bought it and the strike we bought it at. So now we can see we're actually currently losing money on this trade because it is below that $12.13. But not to worry, that's why you're doing this on shares and on stocks that you want to buy, because if they start pulling back, you're not worried, and you're still kind of happy to stay in it. So now we're sitting at $11.50. We now need to start looking at the second part of the strategy, which is covered calls. So we bought it at $13 or the $13 strike, and we may say, okay, we want to sell it at $15. So all we then do is come over to the option chain again, and again go around to around less than 60 days. How about in this example we'll go, or we can even check the premiums and see what the difference are. So going 28 days out and the $15 strike, we would get around $20. If we went to the 12th of August, the $15 strike, we would receive 25. So it's up to you which seems better to you, but for this example we'll just go with the $24 at the $15 strike. So strike of call is $15, premium of that call is 24. Now cost per share, make sure you're putting the right price in here. It's not the strike that you originally bought it at, it is your new break even. So 12.13 is our break even per share. We receive another $15. We're looking at the $15 strike, and we receive $24 to sell that call. Now premium for old calls, like we said on the put side, we haven't had to resell any calls as of yet, so that stays at 0. And then this is also important, number of calls sold. This is basically, if you're looking at the cash secured puts, really how many cash secured puts did you sell? If you only sold one, you put one there, which is 100 shares. If you sold 5 cash secured puts, you bought 500 shares, then now you would be selling 5 covered calls. But as of right now, we'll just make it simple and do 1. So what we now do is go back over, we go to expiry, so the 12th of August, and see was Norwegian Cruise Lines above our $15 strike. So we need to go to the 12th of August and see, did this fill in the money? Going over to charts, we can see it's not actually quite there yet. It's currently sitting at $14.15 at the close on this day. So now what this would tell us is we received this $24, so now we add that over to premium from old puts, but now we need to resell it. We're still looking at the $15 strike just to make everything simple, and for this we will actually have to do a shorter expiry because we're coming up to real time. As you can see, I'm recording this on the 6th of September, so really we can't go too far out. So for this example then we'll go to say the 2nd of September, and we can start saying, did this finally close in the money? So now we would get $50 or $52 for selling that $15 strike. And the reason we're receiving more is it's now closer to that strike, if you were unsure. But now we receive now $52 from that. We've already made that $24. Now let's see, did it close in the money? So all we need to do is go over to the 2nd of September, see where did it close on this day. So again, it didn't actually close above $15. So what this means is you can go over to premium from old puts. We would have made now $52. Oh, actually, sorry. What you need to do is add them together. So all you would have to do is 52 plus 24. Don't think that's actually going to work, but what you can do is actually just do this if you need the help. I mean, on these kind of ones are very simple, but if you're maybe trading with thousands of dollars, it could be a bit less clear. But all you need to see is then that's $76, and so that's all that matters. We can just quickly clear that. But now you've got $76 from that, and what we can now do is add in the premium again. So we can't actually go any further forward because we are actually coming up to real time. But what we can go and do is see where would we get if we sell a call. So again, we go out to around 30 days, so 30th of September, $15 strike, we would now make $38. So now you would make $38 from this, and all we would need to do, we can go to real time now and just see where the stock is currently sitting. So as of right now, it's still kind of below that strike, but we can't go any further in time because we have got to the 6th of September. But all you really need to see though is that if it's not closing above your strike, you are receiving premium non-stop from this, so that's increasing your overall profit. But let's say it is now the expiry, we've made that $38 and now we sold those 100 shares because it is above our strike. What would be our max profit, or what would be our profit then on that trade? So from the 100 shares, so the difference from our average cost per share to the strike, we would have made $287. But we also made money from the premiums. So we made the 76 from the 2 previous calls we sold, and then we made another 38 from this one that we sold. So this would make our total profit $401, which is a 26.8% return. Now, this could be even higher because, as I said, we can't actually see if it starts closing above the strike yet. We can't see if it's closed above $15 because we are at real time. But if it doesn't, and it stays at, say, around $13, you come and go to another 30 to expiry, and you'll probably make another $50. So then you would be at $450, and then you'll probably made a 35% total gain. So this is where the wheel strategy is used. You sell your cash secure puts, you find the stock you want to buy, and you basically get it discounted. If you were going to buy at current price, you instead wait and you get paid. You're still getting it at a lower price than the current price that you sold it at, and you potentially make more money. And then once you start moving to the covered calls, yes, you limit your upside, and that is the drawback of the covered call, is you limit your upside, because if the stock goes up $40 a share, I mean, quite crazy, but if it did, you would still only make that $2 and 87 cents per share. But it is also a way to offset risk, because obviously we're making this premium from these calls. If the stock starts to decline in price, we're at least offsetting that price, so it can fall more in price, and it won't actually be down too bad on the trade. But anyway, that is the breakdown of the wheel strategy. I hope everything was clear. If it wasn't, let me know in the comments and I will answer any questions. Again, if you want that Excel sheet, just check the description. Otherwise, why not drop a like and subscribe, and check out my strategy video that I trade every single day in the stock market.